Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka's fiscal position strengthened sharply during the first 4 months of 2026, supported by a strong increase in revenue collection, particularly from taxes linked to motor vehicle imports. According to the latest fiscal review report issued by the Finance Ministry's Department of Fiscal Policy, the government recorded a budget surplus of 105 billion rupees during the January to April period. This is a significant improvement compared with a deficit of 261.6 billion rupees recorded in the corresponding period of the previous year. Total revenue and grants increased by 34.6% to 1.958 trillion rupees, while total expenditure rose by 8% to 1.853 trillion rupees. According to the report, the revenue increase was mainly driven by high collections from motor vehicle imports following the resumption of vehicle imports. The primary surplus also increased significantly to 862.7 billion rupees compared with 532.7 billion rupees in the same period last year. Sri Lanka Customs emerged as the largest revenue collecting agency during the period, contributing 876 billion rupees or 49% of total tax revenue. The Inland Revenue Department collected 780 billion rupees, accounting for 44% of total tax revenue, while the Excise Department contributed 97 billion rupees. Customs revenue performance was supported by strong import-related tax collections, particularly from motor vehicles. Revenue from excise duty on motor vehicles increased sharply to 187.1 billion rupees compared with 53.2 billion rupees a year earlier. Value-added tax on imports also rose by 35% to 299.9 billion rupees. Overall tax revenue increased by 31.7% to 1.77 trillion rupees, accounting for around 91% of total government revenue. Non-tax revenue grew even faster, increasing by 73.3% to 180.6 billion rupees. Taxes on goods and services remain the largest revenue source, supported by VAT, excise taxes, and the Social Security contribution levy. Income tax revenue rose by 13.2%, while taxes on external trade increased by 30.4%. On the expenditure side, recurrent spending increased by 5.1%, while capital expenditure and net lending rose by 49.3%. However, capital spending remained below planned levels, with utilization at 9.8% of the annual allocation by the end of April. Interest payments declined by 4.6%, easing pressure on recurrent expenditure. According to the report, the economy maintained recovery momentum, with steady GDP growth supporting improved revenue mobilization. The January to April performance indicates that the government has already achieved over one-third of its full-year revenue and tax targets while maintaining a strong fiscal surplus position. India and Sri Lanka are exploring greater use of local currencies in bilateral trade as part of efforts to strengthen economic ties and improve trade efficiency. The initiative was discussed at a high level of roundtable titled Rupee to Rupee Strengthening India-Sri Lanka Commercial Corridor, hosted by the High Commission of India in Colombo. The forum brought together policymakers, central bankers, and business leaders from both countries. Addressing the event, Indian High Commission to Sri Lanka said the proposed commercial corridor would allow businesses to settle transactions directly in Indian rupees and Sri Lankan rupees. According to him, this would reduce dependence on third country currencies, lower transaction costs, and improve the efficiency of cross-border trade. He noted that the initiative builds on the strong economic partnership between the two countries and follows recent discussions aimed at expanding bilateral economic cooperation. A technical presentation by Chief General Manager of the Reserve Bank of India outlined measures being introduced to facilitate local currency settlements. These include amendments to India's Foreign Exchange Management Act and provisions enabling Indian businesses to invest directly in Sri Lankan enterprises using Indian rupees. The discussions took place against a backdrop of growing economic engagement between India and Sri Lanka. According to the report, India has become the second largest destination for Sri Lankan exports. More than half of the foreign direct investment received by Sri Lanka during the past year also originated from Indian investors. In addition, India continues to be the largest source market for tourist arrivals to Sri Lanka. Participants at the forum agreed that a stronger Indian rupee Sri Lankan rupee settlement mechanism could particularly benefit small and medium-sized enterprises by reducing exposure to exchange rate fluctuations and facilitating greater trade and investment between the two countries. The initiative is expected to further strengthen economic integration and support the expansion of bilateral commercial relations. The government says the temporary surcharge imposed on vehicle imports is helping to reduce foreign currency outflows and ease demand for the US dollar. Speaking at a media briefing, Deputy Finance Minister Anil Jayantha Fernando said the 50% surcharge on customs import duty for new personal vehicles is already producing the intended results. According to the Deputy Minister, daily expenditure on vehicle imports had fallen to $3.79 million as of June 12th. He noted that the figure had exceeded $5 million last year and was above $7 million before the surcharge was introduced. The government imposed the temporary surcharge with effect from May 16th for a period of 3 months with the objective of controlling import demand and reducing pressure on the rupee. Anil Jayantha Fernando said the policy decision had helped moderate demand for foreign exchange and contributed to greater stability in the market. He also noted that strong demand for vehicles had been driven partly by speculation and concerns over future market conditions. According to him, vehicle importers opened letters of credit worth $88 million in a single day following the announcement of the surcharge. Sri Lanka relaxed restrictions on vehicle imports in early 2025 after a prolonged ban resulting in a sharp increase in import demand. As a result, foreign exchange outflows for vehicle imports reached $613 million during the first quarter of 2026 and expanded to $821 million by April. The surge in vehicle imports contributed to increased demand for foreign currency and widened the merchandise trade deficit during the first 4 months of the year. Finance Ministry officials stated that the vehicle imports have accounted for approximately $3.3 billion in foreign exchange outflows since restrictions were relaxed. According to the report, rising demand for dollars placed pressure on the Sri Lankan rupee, leading to depreciation against the US dollar and increasing concerns over inflation and external sector stability. The report also noted that authorities took measures to stabilize market conditions and manage pressure on foreign exchange reserves. Government officials maintain that the vehicle import surcharge is helping to curb excessive demand for foreign currency while supporting broader efforts to safeguard economic stability. The government remains confident of achieving its 5% economic growth target for 2026 and is continuing efforts to reach a medium-term goal of 7% inclusive and sustainable growth. Addressing a special media briefing, Deputy Finance and Planning Minister Dr. Anil Jayantha Fernando said the first quarter economic growth rate of 5.1% was a positive indication that the economy remains on its planned path. He stated that while the 7% growth objective is a medium-term target, the government remains optimistic about sustaining economic momentum in the years ahead. According to the minister, discussions are continuing with development partners, donor agencies, line ministries, and private sector stakeholders on strategies to support and accelerate economic growth. Commenting on the recent rise in interest rates, he acknowledged that higher borrowing costs could temporarily affect economic activity. However, he said the government does not expect a significant slowdown in demand and will take appropriate measures to support economic activity once conditions stabilize. The minister also emphasized that the government capital expenditure programs will continue as planned and encourage the private sector to proceed with the investment decisions confidently. He further stated that the capital expenditure should not be assessed solely on a month-to-month basis, as spending patterns for large projects do not follow a simple proportional timeline. Sri Lanka's industrial sector recorded modest growth in April 2026, while lending rates, treasury bill yields, and exchange rate movements reflected changing economic conditions. According to the latest highlights of the week released by the Statistics Department of the Central Bank of Sri Lanka, the index of industrial production increased by 1.6% compared with the corresponding month of 2025, reaching 90.9 points. The growth was mainly driven by high production in the manufacture of wearing apparel and food products. Wearing apparel output expanded by 18.5%, while food production increased by 5.1%. In the monetary sector, market interest rates continued to move upward. The weekly average weighted prime lending rate increased by 25 basis points to 10.25% for the week ending June 12, 2026. The average weighted call money rate also edged up to 9.19%. According to the Central Bank of Sri Lanka, reserve money declined during the week, mainly due to a reduction in currency in circulation. However, overall market liquidity remained in surplus, although the surplus narrowed compared with the previous week. In the stock market, performance was mixed. In the fiscal sector, outstanding central government debt stood at 30,113.95 billion rupees at the end of January 2026. Domestic debt accounted for 18,776.42 billion rupees, while the rupee value of foreign debt amounted to 11,337.52 billion rupees. Treasury bill yields increased in both primary and secondary markets, while treasury bond yields remained broadly stable. The latest Treasury bill auction recorded an oversubscription rate of approximately 1.4 times, while Treasury bonds attracted strong demand with an oversubscription rate of around 2 times. Meanwhile, secondary market transactions in Treasury bills and Treasury bonds declined by 9.8% compared with the previous week. In the external sector, the Sri Lankan rupee had depreciated by 7% against the US dollar on a year-to-date basis as of June 12, 2026. The report noted that the depreciation reflected continued pressure on the local currency despite improvements in several external sector indicators. Meanwhile, global crude oil prices remained volatile during the review period, influenced by developments related to tensions involving Iran, Israel, and the United States. According to the report, the latest economic indicators reflect a mixed but evolving macroeconomic environment, with industrial activity showing growth while financial markets continue to adjust to changing domestic and global conditions. Let's take a look at this week's Treasury bill auction results. With the recent Treasury bill auction, the 91-day T-bill rate stands at 10.02%, down by 7 basis points. The 182-day T-bill rate stands at 10.16%, down by 11 basis points. And the 1-year T-bill rate stands at 10.16%, showing no change compared to the previous week. Thank you for watching. We'll be back next week.